We are going to discuss now the problems based on the adjustment of capital as per the new profit sharing ratio. We have got partners Amar, Akbar and Anthony. Anthony's share, the new profit sharing ratio is 3 to 1. That means out of 6 rupees of profits, Anthony will get rupees 1, Akbar will get rupees 2 and Amar will get rupees 3. So for 1 unit of capital, Anthony has to bring rupees 20,000. So since Akbar is having 2 unit of capital, how much Akbar should bring? So for 1 unit of Anthony it is 20,000. For 2 unit of capital, 20,000 should be multiplied by 2, that will give 40,000 as the capital for Akbar. Similarly, for 1 unit of capital, Anthony is bringing 20,000. For 3 units of capital, how much Amar should bring? 20,000 should be multiplied by 3, that should 60,000 rupees. So the new capital will be 60,000, 40,000 and 20,000 respectively. In case the Amar's capital is excess, for example, in capital account of Amar there is a 80,000 credit balance, 20,000 will be refunded. Similarly, if Akbar is having for 50,000 rupees, 10,000 capital will be refunded to Akbar. So let's go to the problem. We have got Amar and Akbar sharing profit and losses in the ratio of 3:1. The balance sheet as on 31st March 25 is as follows. As usual, all the assets except bank balance will go to the new balance sheet and bank balance will go to the separate ledger account, and Akbar's capital, Amar's capital will go to their respective capital account, and general reserve will be distributed between these two partners, and sundry creditors will go to the new balance sheet. Now let's discuss the adjustments. On 1st April 25, Anthony was admitted on the following terms. Anthony was to be given 1/5 share, and for that he was to bring rupees 20,000 as capital. Then goodwill was to be raised at 20,000. Then furniture and stock depreciation was by 10%, and there was a RDD of 5% on debtors, appreciation of the building by 20%, and adjustment of all the capitals in the profit sharing ratio, which we are going to see now. Now let's go to the solution part. So as usual, let's start with the posting. Land and building will go to the balance sheet. Furniture will go to balance sheet. Stock will go to balance sheet. Sundry debtors will go to balance sheet. Bills receivable will go to balance sheet, and bank balance will go to the separate account. Cash account debits at 20,000. Then Amar's capital will go to the Amar's capital account. Akbar's capital will go to Akbar's capital account, and the general reserve 4,000 will be distributed in their profit sharing ratio, which is 3:1 respectively. Amar will get rupees 3,000 and Akbar will get rupees 1,000. Then we have got sundry creditors which will go to the balance sheet. We have completed the posting part. Now let's go to the adjustment part. Adjustment number 1. Anthony was to bring rupees 20,000 for 1/5 share. In business, cash came, so cash account being the real account, cash account will be debited, and this capital has been given by Anthony, so Anthony's capital account will be credited. So general entry should be cash bank account debit to Anthony's capital account. So on the cash debit we wrote to Anthony's capital account, and Anthony's credit we wrote by cash account. Second adjustment. Goodwill shall be raised at rupees 20,000. In the earlier number of problems, we have seen that goodwill was bought in cash, then goodwill was withdrawn, then goodwill was raised, and goodwill was written off. In this problem, goodwill will be raised for rupees 20,000, which will be credited to the old partners in their profit sharing ratio. Goodwill account debit to Amar's capital account and to Akbar's capital account will be my journal entry. So it will be recorded on the credit side of Amar and Akbar. Then let's go to the revaluation adjustments. Your furniture depreciation by 10%. This is a loss which will go to revaluation account debit side. Then we have got stock depreciate by 10%. 2000 is a loss which will go to revaluation account debit side. Then we have got reserve for doubtful debts 5% debtors. That means there are chances that I might not be able to recover rupee 5% or 20,000. That is coming to 1,000. So this 1,000 being a loss will be debited to the revaluation account. So journal entry in this case will be revaluation account debit to furniture account, revaluation account debit to stock account, revaluation account debit to new RDD. Then we have got land and building appreciation. Your land and building is 25,000 and there is appreciation of 20%. So 20% comes to 5,000. This being a notional profit which will be credited to the revaluation account. Now, a very important adjustment. Capital of all partners be adjusted in their profit sharing ratio, and whatever excess or deficit is there will be adjusted in cash. So the first step in this is that we have to calculate the new profit sharing ratio. In the earlier problems, we have seen how the new profit sharing ratio was calculated. 1 minus new profit sharing ratio will give you 4 by 5. Then this balancing of balance of 1, that is 4 upon 5, will be multiplied by old profit sharing ratio. So that means if we are multiplying 4 by 5 into 3 by 4, we get 12 upon 20. That means out of 20 rupees of profit, Amar will get rupees 12. Similarly, let's come to the Akbar. Balance of 1, that is 4 upon 5 into old profit sharing ratio. Balance of 1 is 4 upon 5 and the old profit sharing ratio is 1 upon 4. That's coming to 4 upon 20. So the new profit sharing ratio is 12 upon 20, 4 upon 20 and 1 upon 5. So in order to make here 20, we multiply this denominator and the numerator by 4. So we got 12 upon 20, 4 upon 20 and 4 upon 20. That means, in other words, for every 20 rupees of profit, 4 rupees will be given to Anthony, 4 rupees will be given to Amar, 4 rupees will be given to Akbar, and 12 rupees will be given to Amar. So we divide this by 4. 4 ones are 4, 4 ones are 4, 4 3s are 12. So the new profit sharing ratio is 3:1:1. So calculation of new capital as per the new profit sharing ratio. New profit sharing ratio, as we discussed just now, is 3:1:1. So for 1 unit of Anthony bought 20,000 as his capital. So Amar's new capital should be 20,000 into 3. That will come to 60,000. Similarly for Akbar, for 1 unit of capital, it should be 20,000. So the new profit sharing ratio will be 60,000, 20,000 and 20,000. So in the partners capital account, we write to balance carried downward 60,000, 20,000, 20,000. So we wrote all the 60, 20, 20 here in the capital head. In outer column we wrote 1 lakh rupees. So adjustments over. So first we proceed to close the revaluation account. The credit side total is 5,000 and the debit side total is 3,200. So we are getting a differential amount of 1,800, which is a revaluation profit. This revaluation profit will be credited to the partner's capital account in the ratio of 3:1. Amar will get 1,350 and Akbar will get 450. So here the journal entry should be revaluation account debit to partner's capital account. Then we close the partner's capital account. Anthony 20,000. Then we close Akbar. Debit side total is 22,000. The credit side total is 22,450, and as per the adjusted capital, the capital of Akbar should be 20,000. So there is an excess of 2,450 in Akbar's account. So which will be adjusted in cash. Credit side total is 22,450, debit side total is 20,000. So there is an excess of 2,450 which will be refunded to Akbar. See. So the journal entry will be, since Akbar is the receiver, Akbar being a person account, debit the receiver is the rule. So my journal entry should be Akbar's capital account debit to cash bank account. Then when I go to Amar debit side total is 60,000. Here the debit side total is more and credit side total is 49,350. So there is a deficit of 10,650. So Amar will bring 10,650. So cash will come in the business, cash being the real account, and the rule of the real account is debit what comes in. So in business, cash comes in. So cash account will be debited, and this was gained by Amar. So Amar's capital account will be credited. So the journal entry will be cash account debit to Amar's capital account. Now we close the goodwill account. We have got a balance of 20,000 in the goodwill account, which will go to the balance sheet assets side. Now we close the Akbar's capital account. There is a balance of 48,200. So there is a totaling mistake here. It should be 50,650. So the balance figure is 48,200. So we close the balance sheet. So the both sides got tallied and we have completed the problem.